Good
Okay,
afternoon, everybody.
afternoon.
As I see you guys streaming in now, just like wait a little bit before I kick off my session.
Yes. How's everybody? Hope you're doing fine. So, okay, if you're in the chat, right, if y'all can hear, can y'all just type yes? Just do us that favor in the chat box. Okay, great, Terence. Thank you.
Okay, is it clearer than the time before? I mean, for those people that participated before, I've moved on to a different part of the house because Ethan was saying that it lags quite a bit, so I decided to move up.
Yes.
As
Okay,
clear as last time.
Yeah.
Better. Okay, great. Just some housekeeping. Oh, am I taking your job away from you, Ethan? Because
No,
if you have
no, no.
if you do have any questions, please like put it in the Q&A column rather than the chat. Because later on, when after my presentation, and I'm gonna bring in a special guest later on, I would be focusing on the Q&A part.
Okay, can. Okay, it's 12 o'clock. Without further ado, Terence, you can actually take the time. Time is over to you.
Okay, let me just first share the screen.
Anyway, just to some housekeeping rules. If you have any questions, please put it into the Q&A section and not in the chat, okay? Because Terence will just focus on the Q&A portion. Thank you.
Ethan, I need some assistance to share screen because it says the host have disabled screen sharing.
Okay. Just give me a minute. You can share your screen. Can you share the screen now, Terence?
Okay, let me try. Nope, it still says host disabled. Start my video. Okay. No.
You can try again. Give me a minute.
No worries. There's some Q&A questions. Maybe I'll take a look at it right now. Ethan, as you're trying to allow me to share the screen. Okay, some questions on construction sector, Thai Bev. I think there's a question that I may have to refer to Jeremy. There's a question on Clearbridge, biolytics.
Okay, Terence, you can try again. Sorry.
Can do. All right. Sounds good.
Okay, got it.
Okay.
Time is yours.
All right. Hey, hi everybody. Good afternoon once again. It's been 2 weeks since we last met, and I believe a lot of things have happened. Very, very fluid. I mean, the entire market has been extremely fluid. The same I can say for the last 3 months. But it's a whole new ball game right here, and I feel that it's not only me actually. A lot of the financial experts have been thinking that there's a total disconnect between what is happening to the stock market and the real economy. We have been reading about really, really bad news out there. WHO says we have a long, long way to go before things will return to being normal. If you look at the record number of jobs being lost, 20.5 million jobs in April, and total, I think we are talking about to the tune of 36 million jobs that are lost out there in the US alone. And we're not even talking about the millions of, what I'm worried about are the millions of people that have lost their jobs in the likes of Indonesia and India. I mean, in the US, they can continue to print their way out of trouble. Jay Powell has been talking about using the printing press and doing QE to the power of infinity to actually help the people out. But not every country is so lucky. In fact, I think that US and to a lesser extent, Europe will be in the enviable position. Other countries, they can't do such things. If they were to do it, subsequently down the road, there will be inflation issues and the economy may come to a total halt or may crash. So you have that happening, and even US and China, they're fighting right now. All these things have been happening over the past week. And you have experts telling us that, hey guys, we are not exactly there yet. In fact, we may be quite far down the road before we hit the bottom. Fed chairman, I mentioned just now, Jay Powell, he's saying that more economic stimulus may be needed, and I do get it. A lot of people are feeling that given that there's this ultimate firepower, the infinite ammunition from the Fed will allow the markets to rebound quickly. We're going to see a V-shaped recovery, but I'm going to conclude later on. I'm going to jump the gun to tell you that I believe very much that this is not going to be a V-shaped recovery. It has been my theme actually since March when the virus first broke out. I don't think that this is going to be V-shaped recovery. Just like at that point in time, a lot of people were wondering, mulling over whether there's going to be a recession or no recession. To me, it was very, very clear. It was going to be a recession. It's going to be a long-drawn recession. People were speculating whether it's going to be V or U shape. I think that it's going to be a crawling U shape. So you're going to go down and it's going to stay bottom for quite a long while. And the godfather of the stock market, Warren Buffett, tells people that he's not buying anything right now. In fact, he's selling off. He's actually reducing the number of holdings that he have. Last quarter, Berkshire actually lost a record $50 billion. Of course, a lot of it is still unrealized, but he has realized some of his holdings in the four airlines. He has totally sold off every one of the major holdings in the four airlines that he holds in the US, saying that this is one of the more regrettable positions. Yes, last Friday he also announced that he has already sold off his position or the bulk of his position in Goldman Sachs, as well as a little bit of Bank of America. So even at the financial side, he's looking to be bearish on. He is shoring up cash, definitely. I believe that he has a tune of 137 billion. And and if he continues doing this, it may be over $150 billion. He should be looking for an elephant acquisition like he normally does. At a point in 2008, 2009, the Great Recession or the global financial crisis, that's where he found the best value and actually came in to support the likes of GE, to look at the banks, and he struck very, very good deals. At this point in time, he not only is he not striking deals, he is shoring cash. So that is a sign that there's no bottoming out right now. But there is a big disconnect with the market, as I mentioned earlier on, between February 12th, where we saw the peak of the near-term peak of the market till March 23rd. March 23rd has been embedded in many people's memories as the worst day, right? And that's where they did a big recovery. All of the major indices, including our STI, okay, STI is not exactly major, but all the major indices were down over 30%. But what was amazing is that in the US, people seem to have disregarded everything, and that's why we mentioned the disconnect at the start. It continued to bounce up tremendously. Right now, as of the week before, it was up over 30%. Last week, it gave up some gains, but the futures continue to roar, I think, overnight. So this coming Monday, we may open higher. But we are just wondering, why is that such a case? And I feel that we are on very, very fragile grounds right now. There are many things that can actually break this rally. It could be a straw that will break the camel's back. One thing is, as we're opening up, a lot of people are buoyed by the fact that we are opening up our economy, thinking that the worst is over, because once you open up, people will start to come in, people will start to shop, people will start to go to restaurants to eat, and then the number of unemployed will actually diminish. One thing's for sure. I mean, you see the number of unemployed is growing, 36 million in the US. It probably will grow past 40 million. Sure, a lot of people will come back, but there will still be tons of people out there that is going to be unemployed, and this will have an impact, down the road, because America, the US is actually a consumer economy. It counts for like 2/3 of the economy. If the people don't have a job, they're not going to go out to buy things, and I think that that's going to have an impact on the US. and that will spread to the rest of the world because they are the world's largest economy. Um, but if a second wave does come, I feel that that is going to have quite an important impact. Some people are saying that, oh, will it be like Spanish flu? Because Spanish flu, the second wave, it is going to be, it was worse than the first wave, much worse. I think on my base case, I don't think that that's going to happen. But a second wave is a high possibility. It should be well contained, but it will still send fear into the market. Continuous weak economic data, because right now we're assuming that the second quarter is going to be the worst. What if things don't improve with time? Third quarter will just be as bad or just improve slightly, and we'll be in a very, very tough position because at that point in time, already J Power is saying that we need to have more. We need to have more firepower. We need to do things differently, and they do have some things in their arsenal to actually buffer this. So they need to take out everything that they have and more. And worst thing is geopolitics have also like come into play. There are a lot of the non-virus related issues. Actually, it's related to virus, but this has been brought in by the US. There's now a blame game about who started the virus, and the US is saying that we are gonna like look at the trade deal. We're gonna relook at everything. Basically our relationship with China. And when the world's number one is at hit or like attacking the world's number two and they're not talking to each other, I think that this spells trouble. The rhetoric will grow stronger because remember this year in November, that's going to be the year where Trump seeks re-election. It seemed almost so safe at the start of this year, because unemployment was like a record low, GDP was going up, people were happy, stock market was at its all-time high. But things unraveled very, very quickly within 2 months. Again, and I think that there will be this back to fundamentals somewhere down the road. I don't know when. It may be tomorrow, it may be next week, it may be next month. But somewhere in the near term, people will realize that the markets are expensive. If you look at the benchmark S&P 500, why S&P 500? Because it's a broad-based index. Nasdaq is very focused on tech. The Dow Jones is very concentrated on industrials and some tech. There's only 30 stocks. S&P 500 spreads across, and I think that is a good benchmark. A lot of people, some people are now saying that it is the most expensive, possibly the second most expensive of all time, and it's over 20 times PE. Time to relook at it. If this narrative is gonna start to spread, people are gonna think about it. One day, the investors will stop investing in it, and that's where I believe we are going to see a second wave of the downturn. In terms of Singapore, quite a few companies have already reported 50s. In fact, I believe close to more than a quarter of the companies have already reported their numbers. In fact, now I think it's possibly most of it in the first quarter because it has to be over by the 15th of May. On average, we are looking at 56% of slump in the earnings for the general market. In terms of the index, the STI stocks, we are looking at about the same, about 54% down in terms of earnings. What is key is that people need, or the analysts are, the people are looking towards the analysts for direction about how bad this is going to be. Analysts, I've said in previous webinars that, given that as analysts before, we are often very, very slow when it comes to, very, very measured when it comes to reducing the earnings. And we are typically behind the curve. So currently, the earnings decline, or they think that the earnings decline for this current year in FY20 is going to be 20%. As a reference, the global financial crisis, it was 40%. So we have already like made clear that this year or this current crisis is going to be worse than GFC. And given that we have been, in terms of our earnings, be at very, very lofty heights, I don't believe that we are only going to see a 20% decline in earnings. There needs to be some downward revision when it comes to earnings estimates. And I believe that would also have an impact on the markets. In terms of analyst buy ratings, my colleague David actually put out some interesting data from Bloomberg. If you look at the number of buy ratings versus the entire universe, we are currently at 53%, which means that there's more buy ratings than sell or hold, right? At the bottom of the market in the GFC, we saw 45%, right? At the peak, if you go run back to 2018, 2019, about 70% of the calls were buy ratings. I think that there's still some way down to go in terms of revision. And as I mentioned earlier on, if there's going to be a revision, there will have it will hit the market because as you continue to call sells on stocks, this will impact on the confidence that investors have on particular stocks. Okay, but not all is gloomy. There have been outperformers over the last 2 months. Many of you will probably be very, very familiar with some of them. Top of the list will obviously be something that we have gone in every other day because there's really nowhere else to shop. And we are home basically like eating, baking every day. So you can see that the supermarkets from NTUC, FairPrice, Cold Storage, Sheng Siong, they are all packed. And if you look at the numbers for Sheng Siong, it really, really reflects, the positive, the positive impact this virus has. Earnings jumped 50% in the first quarter, and we are only talking about 1 month of contribution. What about April, May, where people are locked up at home? Because that's the part where there's a circuit breaker. A lot of people are going out there to the supermarkets because they don't have access to restaurants anymore, right? Or they have very, very limited access to restaurants, and people just want to be master chef during this period of time. And things, everything goes back to supermarkets, get connected back to supermarkets. Even during when they introduced the first circuit, the circuit breaker before the extension, or the extension of the circuit breaker where they locked up all the bubble tea, people went crazy and they went to supermarket to buy all the tapioca flour. So as a result, like I said, everything leads back to the supermarkets because there's really lack of options. Earnings jump 50%. I think they will continue to do well. I'm not too sure whether the current quarter will see such a big jump. But of course, I'll throw some caution, given that it's all about valuation. We have to be very, very focused on the valuation. Currently, after the stock price has surged some 50 over percent since March, we're only talking about less than 2 months. It has really surged 50 over percent. The counter is trading, maybe one plus standard deviation away from its mean. Its mean is like 20 times. Currently, is trading 25, 26 times. So remember, guys, everything goes back to valuation. Sure, we can have the initial rush and euphoria, but when the market tames and sensibility returns, valuation will be something that you have to focus a lot on. Another industry that have done particularly well are gloves. And gloves, I've seen companies involved in gloves, PPE, over the last 2 decades that have been involved in the market. The bulk of them are actually listed in Malaysia, but one of them, like Top Glove, being the top player, they also have a secondary listing over here. Riverstone is another guy that has been listed for quite a long while over in Singapore, but their presence is totally in Malaysia. They're riding on extremely strong demand. Many of them are reporting, north of 95% capacity utilization, because all the healthcare professionals need gloves. People right now also very kanchong, so they also want to buy gloves. Well, 90 over percent, they're almost like hitting 100%. Riverstone itself is expanding facilities in Taiping. And interestingly, because it is in a very sweet spot, that one have to consider. You are earning in US dollars and your cost is in ringgit. And guess what? Ringgit has been falling with respect to US dollars, so the margins have expanded tremendously. In Top Glove's case, we're talking about 5 percentage points just quarter on quarter. We're not talking about year on year. Year on year, there's a big gap, right? Quarter on quarter, 17% to 22% EBITDA margins. I think that's very, very impressive. So we're going to expect to see a jump in earnings. That's a foregone conclusion, and that's why people are very, very excited about it. But again, let me caution you, it is going to be a matter of valuation. I don't cover the glove makers, but I do monitor them. Top Glove, in terms of share price, have gone up 67% since March, and Riverstone 140% during this period of time. Healthcare. Healthcare, guys, have also been up quite tremendously, 26% since March. But it is not a rising tide that lifts all boats. We've got the hospital and clinic guys that have seen some a retreat. Why? People say, hey, but healthcare very defensive, right? Not typically so in this case, because during this coronavirus, we are all locked up at home, right? And the hospitals and the clinics will only see people with and they call it those essential or critical cases. So hospitals, a lot of the times where you have non-essential stuff, they won't see you. You'll likely see a drop in the numbers. In fact, SMG, Sing Medical Group, it has enviable clinic count. You can see the numbers actually coming off, and they are even cutting the dividends because business this year will not be great. So the hospitals, clinics are seeing down, but who's seeing up? Who's gone up in this healthcare segment? It is going to be the med tech guys, medical tech guys. And I've got Jeremy on standby here. He's the CEO, founder of Clearbridge. I will bring him on later on, and we can have a chat with him on what's going on in this space. So I don't want to be like the last time. Last time I just took far too long on my presentation. We didn't have enough time for an active discussion. I spent like half an hour. There was only like half an hour for chit chat. This time around, I'm going to keep my presentation short. Final words. You already know my conclusion. I mean, if you've been following the webinar, I think the market's expensive. Whether is it the US, Singapore, anywhere in Asia, I feel that it's expensive. We are far too optimistic. There's a great disconnect between the market and the market as well as the economy. And I'll say that again, there is a great disconnect. So and I do get why people are excited, because they feel that the worse it gets, the more the Feds will come in to save. But the Feds will have limited firepower, even though they say it's QE infinity. Why do I say that? Because they may be able to save. They may be able to save the US, but they cannot do it globally. And a lot of the companies, since we are so interconnected, the companies in the US will feel it, the markets will come off, and this will impact the rest of the markets, given that, again, the equity markets are also very, very intertwined. So I can see a chain impact happening. So V-shaped recovery, very much of a fantasy. Today, I will stop here, and I just want to stress again, I know that I have left many questions unanswered the last time around in the Q&A. If you do need to ask me questions after this webinar and I'm not able to take it on today, you can just go into my Facebook, my official company Facebook page, Terence Wong Azure Capital. You can pop in the questions, and I'll try my best to answer as fast as possible. So right here, I'll stop sharing, and I'm going to bring on the guest that I have. Very, very excited because, like last few webinars, it's just been just me and all me. It's a monologue session. Today, I'm happy to share the stage with somebody. And this company that he represents, he's the founder, CEO of Clearbridge. Clearbridge has done exceedingly well. Jeremy, are you there? Yeah, Clearbridge have done exceedingly well. It's like doubled in terms of the share price. It's a med tech player. It's garnered a lot of attention, and that's why I bring Jeremy on. Jeremy, hi, how are you doing?
Hi, how are you? Hi, Terence. Hope everyone is safe.
Yeah, Jeremy is an old friend of mine. We've known each other for many years. At that time when he was called, even before he listed, I remember he was like even though he was a senior management, he was a CEO of Cod Life, and he was selling me packages. I remember he had a big seminar, and he was the one selling me the package for my first kid. And subsequently, when he got listed, I was interested in the company, so I brought him to Tokyo. I was then the head of research of RHB, and I think that he's a really impressive work ethic. In Tokyo, there were 8 CEOs of listed companies together at SGX. We went there after a grueling 1 day of marketing, 2 days of marketing. We were having dinner. Most of us, 7 of us, the 7 CEOs were casually having nice Japanese dinner. Only Jeremy was just outside the door, like talking and talking, doing meetings over and over. And he only had 20 minutes. So a lot of the CEOs were going, wow, this guy is really, really hardworking. He put us to shame. Impressed with the work ethic, as I said. And in 2016, I remember I met up with Jeremy again. At that time, he had left Quad Life, and he was telling me about this idea of his, and he is gunning for listing. And to tell the truth, Jeremy, I really didn't think that you will be able to list so soon. Can you tell us a little bit more about Clearbridge?
Yeah, I can. Hi, good afternoon, everyone. I hope everyone is staying safe. Okay, maybe on the context of Clearbridge, just a very short history to it. It used to be called Clearbridge Accelerator. It was essentially set up like 11, 12 years ago to try to, together with the government in Singapore, right, MTI, they had this program of co-investment of a dollar for dollar matching scheme to try to grow billion-dollar companies through medical technology investment. At that point in time, in 2016, I just left Quad Life. I didn't know exactly what to do. Did some soul searching, spent a couple of weeks off, spent some time with the family. And there was a gentleman by the name of Johnson Chen, who was the founder of Clearbridge Accelerator, and needed to pivot the company, simply as that. And at that point in time, I had my own vehicle and reversed into Clearbridge Accelerator and tried to position the company for listing because it's got 2 medical assets, or rather I would say technology medical assets right there, but they were not close to being commercialized yet. So it requires quite a fair bit of education for us to essentially repivot the company, to tell investors that we need to repivot the company. And the second, of course, is to turn these medical technologies into monetization strategies. There must be a way in which you monetize this medical tech. And that was what I alluded to do in the prospectus in December 2017. And you could actually see from our P&L at that point in time, when you launched a prospectus, everyone was laughing because we only had barely $200,000 worth of revenue. But last year, just about 2 years later on, we clocked in about $21.53 million of revenue. And I must say that we have crossed the EBITDA inflection path on this entity. We also found a way out for our medical technology companies. One of them essentially is a company which used to be called Clearbridge Biomedics. Today it's called Biolytics. Yeah. So we monetize that technology in the company as well. I'm more than happy to actually answer any question. Maybe just to go through on a very high level note on our Q1 results. Now, remembering this, we have already done 2 years of listing for Clearbridge Health. So it's no longer mandatory for us to do quarterly reporting. I choose to do quarterly reporting. I continue with it because I feel that number one, it removes a lot more questions away from analysts. The quarterly reports that we put out there is self-explanatory as to what we are. It alleviates us from any potential moral hazard questions that the market may have. I mean, it's really a mystery in the stock market that how companies are performing during these very volatile times. We chose to actually do this quarterly reporting for that purpose, right? Number two, we believe that at this point in time, after 2 years, our EBITDA focused strategy has been fairly successful. It could be faster, but we were essentially being dragged down by a lot of work that we did for associate companies such as Biolytics. But we actually have such a big portion in that company, close to about 25% of the company, that it's inevitable that I personally myself get involved in that entity as well, right? So so the EBITDA focus strategy has been going along. If any of you actually noticed the trend for the last 2 years and how I've been pitching to the market all the time, there are essentially 3 pieces in Clearbridge Health. The first piece essentially is something that you guys are very familiar with, right? Except that we are asset-light and we are regional. That is the medical practice business. Why do we need medical practice business now? It goes back to the reputation that Singapore has had, or rather has still in the market in terms of medical excellence. Last year, if any of you noticed, the Singapore General Hospital, right, was rated as the third best medical healthcare system in the whole world. The first being Mayo, the second being Cleveland, and the third being SGH, which means to say, right, if you look at the Southeast Asian market for medical healthcare, that's the main reason why Singapore healthcare business has been doing well in the last 2 decades, because of medical tourism simply coming to Singapore. Now, new equation comes along, a new scenario, a standard error called COVID-19. Who's going to be able to fly in? Now, those guys that has a vision of establishing the Singapore practice overseas will probably win. That is about 2 years ago when we decided that we should bring Singapore-based healthcare overseas. I started from there, right? So we acquired Philippines, we have businesses in Indonesia, and we have a presence in Hong Kong to capture the mainland Chinese and the Greater Bay Area, right? We are still moving along to look at all the other countries such as Myanmar, potentially Vietnam, Thailand, and Cambodia. So we are not an earnings aggregator like a few other companies that you guys may want to put a definition to. We are not. We are simply taking the best in Singapore standards that we can find. At the same time, there's no earnings drag on those entities that we acquire, but we are putting those medical practices overseas. That's what we've been doing, right? So that is the medical business. The second is that, as you may know, the bulk of the population in Southeast Asia, close to about 700 million people, maybe about 4% can afford private healthcare in private hospital settings. But what about the rest of the other guys then? And there's a lot of bulk in that area. And one of the key things that we want to do is that, okay, actually the private hospitals don't need our help anymore, right? The Cilium and the IHH, the Pangtai Group, the Columbia Asia and all that, they don't need our help. It is the public hospitals that requires some amount of Singapore expertise. So that's where we have our first foray into a public healthcare scene, not only just to basically be in a position to participate locally in the local governmental reimbursement schemes, but at the same time to be in a position to put ourselves as private operators within a public premise so we can get scale. Well, so today, right now, we are managing close to about 50 hospitals, from renal care to pathology in Indonesia. And this methodology is set to continue to move. As you know, we have a 4-story medical center in the Philippines. And that essentially, right, has got a lot of legs into this COVID-19 pandemic as far as the Philippines is concerned. That's why we were very close to being one of the first few movers in the Philippines for a COVID-19 kit, a detection kit. Now, the third area that we have been always focusing in and talking about is the precision medical side of things. That means to say, we are in a position to understand, and underlying, cancer condition or illness condition of a patient. How do you go about doing that? Essentially, is to have a capacity, right, and understanding on disease types. And this is where the scientists and the laboratory move around a lot. Some of which can be CAPEX intensive, some need not have to be. But our methodology has always been arm ourselves with the basic needs, but that we can always build, borrow, or buy later on. So most of the time right now, as far as the precision medical bit, we have been borrowing other people's assets, such as our collaboration with the Pyramid in Melbourne, and more recently, right, to run cancer liquid biopsy assays with Lian Chuan Bio, which is based in Hangzhou, a fully licensed pathology laboratory in China. Now, why China requires a special thing of its own? Because, as you know, medical specimens cannot come out of China for any pathology work, zero, right? And that's the reason why there is a need for medical specimens to remain in China, to be diagnosed and to be treated in China. As far as Singapore is concerned, I think Biolytics has just executed with, IPTs and everything already cleared by shareholders. And it was essentially to acquire the license and the technical expertise and accreditation of CAP, stands for College of American Pathology, right, of a laboratory called Biomedics Laboratory. So in Singapore, right, we will replicate what we can do or what we will do in China as well. Except that this particular laboratory today is a bit different. It is CAP accredited. It is the only licensed CTC, circulating tumor cell laboratory in the whole of Southeast Asia, and is in the midst of applying for CLIA. Now, CLIA stands for Clinical Laboratory Improvement Amendment, right? Which is something like, say, Guardant Health in the US has CLIA licensing, right? So in a nutshell, right, Clearbridge Health comprises of all these three elements. It is important to note, right, that Clearbridge Health has an exclusive call option to buy further 10.35% from Spring Singapore. Spring Singapore, as you know, belongs to MTI. It is now called Enterprise Singapore. They keep changing name, but essentially they're the same thing, right? So we have a call option until November or December end of this year to acquire the remaining 10.35% from Spring Singapore. Requires cash, of course, but cash being aside, right? If we do that, we end up crossing the GO mark. We can, of course, buy a club as much as we can to 29.99%, but it's until the end of this year. So we will take our time, right? And I think Spring can possibly extend to us another 1 more year or something like that. It's up to negotiation with MTI because you know what? They don't have a trading account. They can't sell, right? And the exclusive call license is still with us. So that being said, I'm more than happy to answer questions. This year's numbers and everything, we put up a PowerPoint up onto our own website. I think this is available on the website, and the information there are as transparent as we can get, right? Everything is right to the dot. It's prepared by my very seasoned financial controller, Felicia Lee, as well as my chief commercial officer, Jonathan Liao, who are two very important people in the company. They understand the entire group, also Biolytics, because we have to do fair value on those investments as well. But I can tell you that from this set of accounts, you can see, right, that the inflection has already started to happen. That is the story of it. And we are pretty well hedged. Why in this COVID-19? Just now Terence talked about a few entities in Singapore where the clinics started to dwindle because of the fact that there are no Indonesians coming here and so on and so forth. And that's the payback for having some amount of vision on regionalization. Regionalization is also another way for us to diversify our risk in the same segment, in the same business, right? Now, if a CEO comes to you and say, you know what, I'm an investment holding company and diversify, all over the place, I don't like doing that because I think investors can diversify better than us, right? But I'm in the same segment. If Singapore is down, Hong Kong is up. And I have an entity in Hong Kong that didn't used to do well because of the protests, but now Hong Kong ended up being closest to mainland China, and they're supplying quite a fair bit of medical equipment and all that to different entities around Southeast Asia, including different parties in Europe as well, because we are closest to China. So, when one counter goes down, one local entity disappears or have a problem, we have a counter effect on the other side that sustain our earnings or our revenue flow for the coming year, which is, to me, a hedge position. Yeah. That's Hong Kong. And in the Philippines, it's pretty interesting because of the fact that we have a full-fledged 4-story building and we've been collaborating with public hospital as a basis for us to move forward. We have like conglomerates contacting us and public hospital system contacting us for our COVID-19 kit. And that's how we gotten ourselves a Filipino FDA approval so fast, because they went through the entire validation study in certain public hospital, which I will not name, right? in 2.5 months ago, as early as 2.5 months ago, even before the HSA approval was being done. So these are operating work that our guys on the ground have been doing for the past 2-3 months, tirelessly working on it. Yeah, and I must say that we are actually in a really good and nice position today. Yeah.
So Jeremy, you were talking about biolytics and the COVID-19 test kits. I
Yeah.
think that there's a lot of attention on that one.
Yeah.
What would the relationship be between Clearbridge and biolytics?
Yeah. On the 30th of April last month, we have had an AGM and EGM held by biolytics directors. Right. We were probably the only gung-ho Singapore company that went ahead with web-based AGM, and we did it anyway. We seek shareholders' approval for IPTs between CBH, Clearbridge Health, and Biolytics. Essentially, we can end up as a non-exclusive distributor for Biolytics COVID-19 detection test kit, which is what we have gotten. 100% with our votes not voting at all. We abstain from it. 100% of shareholders say, hey, let's do this. So we cleared IPT last month, about 2 weeks ago. And our strong points are in the regional side in Southeast Asia. We have contacts in Thailand. We have contacts in the Philippines, as well as in Indonesia. And usually, right, we will be loading up on a test kit to public hospitals. As you know, we have very close relationship with public hospitals. Even private hospitals do sometimes, actually a lot of times, work with public hospitals. Say, for instance, in the renal care arena, right? When there's a traffic jam for patients in renal care in the private hospital setting, those patients will naturally flow to the public hospital side. Because, the margins on those are exactly the same, because renal care is 100% reimbursable in Indonesia under BPJS. So regardless of which hospital they go, it's the same. And patients are typically agnostic. They just want to make sure that they don't die, right, from kidney poisoning and things like that, or poisoning of the blood, septicemia and things like that. So that's the current situation today. We will be getting involved, in the selling of the COVID-19.
Question on Vincent Tan has this question on your status of selling test kits in the Philippines. Has been for a while, and you mentioned that earlier on.
Yeah. We have actually been doing a lot of clinical validation, right? I mean, the test kit is Biolytics' own test kit, right? So without going into so-called selective disclosure, that a lot of people have been asking us, including the exchange and everything. I mean, everyone is just wondering, hey, this is a young punk company, how come they can do these things, and a lot of billion-dollar based public institutions still struggling with this? Because we are asset light, we move fast. We're like commandos in the jungle. There's a difference in bringing a whole horde of army and a whole regiment and maybe a platoon of soldiers and the work that you want to do, depending on the kind of work you want to do. And this is typically us, right? So there's no BS about being asset light. This is where you see the advantages of doing that. And in terms of the validation work in the Philippines, when we got our product, before every one of them has gotten approval, we want to do clinical validation on the instrumentation, right? And we tested, or rather the public hospital took over the kit and tested on active COVID-19 patients. And then we compare the data. Data doesn't tell a lie. And that's how we managed to get our COVID-19 kit Filipino FDA approved. That's what it is. Yeah. That was about 2 months ago.
Okay. And other Southeast Asia countries, another question, and other Southeast Asia countries will follow suit, right?
Yes.
Since we have the non-exclusive
we are working.
rights.
Yes. Well, we are working to ensure that there are some Southeast Asian countries, right? They may not really respect their own local authority approval process, to be frank. So they latch on other people's approval, process, such as Filipino, which essentially, right, has a pretty mature process actually for evaluation, because everything they follow America, just photocopy, and they've been around there for like many, many decades. I mean, Philippines has been around as an independent country before even Singapore became independent, to be frank, right? So because of social reasons and political reasons, the last 40 years, he's lagged behind. But you'll find out that, actually Philippines has been a much more progressive society, right? In the early years of his life. And the system has been there for quite some time. In Singapore, HSA is only a provisional authorization, meaning to say, right, that just like in the US, under emergency authorization use format, they will grant any number of instrumentation and diagnostic kit out there that they can approve, so that it cuts down the bureaucracy involved in the approval process. This is the EUA equivalent in Singapore, so we've gotten that. But to be frank, right, we have not sold any of our kits in Singapore to any GPs. Yeah, we have not. Our business has generally been outside of Singapore. Yeah, generally outside Singapore. So that's where the complication is, when there's a lot of rumors, right, saying that, hey, your test kit is not accurate, this and that. Hey, I'm relying on data here. I'm not relying on where you read, which tabloid you read, which Yahoo news Yahoo is not the tabloid, but which news you read out there, and say that, well, this is not accurate and the Abbott one is 100% accurate. But look, Abbott technology, 5-minute rapid test kit, nucleic acid test, has been compared to Cepheid, which is a Danaher-based company, right? And he's found to be he has an error rate of more than 30%. I find it quite strange that people will say just because it's a big damn brand name, then they must be good. It's in the data, guys. It's in the data of how much you do and how much you validate. It's not in the brand name. Okay. So as far as we're concerned, right, we will continue to be working with healthcare professionals outside of Singapore and be implementing those screening measures together with those guys outside of Singapore.
Hey, Jeremy, I've got a bigger question. I mean, a bigger picture question for you. In terms of the numbers, you are positive. Going ahead, what kind of catalyst do you see like allowing you to grow this EBITDA and potentially to earn to be positive in terms of the bottom line?
Okay, there are two things here, right? We continue to do what we do, meaning to say, for instance, we continue to acquire the smaller entities outside of Singapore and bring them in. That is a natural sure path, because one of our main criteria is that we cannot just acquire an entity and then lose money. It becomes an earnings drag. People won't understand that, and actually neither will I, right? But more importantly, right, is that how we have the ability to scale up. I think Indonesia, as far as we are concerned, too much of an Indonesian asset can be too much of a risk to everyone. So we're more or less done there. I'm more interested in the other two countries that has more than 100 million people in population, which is the Philippines and Vietnam. Now, Vietnam is very socialistic. It's hard to get into Vietnam unless you go into a joint venture. Currently, the country don't like it doesn't allow 100% acquired entities or foreign entities to be residing there. And because as a socialist country, they control land costs. And you typically, for me, I never like land costs. I don't like to have high capex on, right? And Philippines is more likely for me to continue to expand. Southern of Philippines in the Cebu area, that sounds to be quite good. We continue to look into places like Myanmar that looks to open up to more Western style medicine, and they trust the Singapore branding. So we're more than happy to be there. I've been there about 3 years ago, and I will continue to look at opportunities over there. Scale, medical practices overseas, these are two ways that can continue to increase our EBITDA. Now, finance cost is one aspect. We all know the cost of capital, WACC. There's hidden cost of capital because of cost of equity. You don't see it, but investors typically don't see how much cost is attached to equity because it's calculated. It's not transparent in the P&L. We have been funding our acquisition, right, through debt. Recently, there was about $2.6 million of our convertible bond being converted. Not me, I'll be the last one to convert, of course. I have to convince my CB holders. But they have converted, which means to say that our financial cost burden going forward will be going down. I think in it was disclosed sometime in April. So therefore, your 31st March accounts is not reflected in there, but it was done sometime in April, right? But from the public announcement that we put a lodgement onto SGX, you can see that. So our finance costs will continue to dwindle down. Now, in a low interest rate environment such as this, with government backing almost every asset, hey man, of course we're on a bandwagon, right? Yeah. So interest cost goes down, financial cost goes down, our earnings profile will go up. That's the other thing. Yeah.
Okay. For those people not familiar with Jeremy was a CFO before, so he talks in terms of numbers. He's very, very familiar not only of the very big picture, but also of the numbers.
Yeah, I mean, the numbers don't lie, right? So I like numbers. So a lot of people talk about, wow, here, you see that, I don't like that. Yeah.
Okay,
so
thanks
these are the
so
two major
much.
factors. Yeah.
Thanks so much, Jeremy. You've been a great help in explaining what Clearbridge and a little bit of biolytics is all about. Biolytics, I mean, both counters have done tremendous during this period of time. Looking at the charts right now, Clearbridge is up 100%. Biolytics is just over 100%. Congrats once again. Hopefully, more interesting things to come for the company.
Thank you, Terence.
All right. Thanks so much, Jeremy.
Thank you.
Okay, I'm gonna take on the rest of the questions that you have. I think we've only got 10-15 minutes on the market itself. Okay, what update on the construction sector outlook, please? I think that construction, I've mentioned this before, construction will be very, very challenging. I mean, you can look at the things that's happening over in the dorm. There's 20 over 1,000 people, and the count will likely go up. Many of them will only start working a lot later. And of course, the government said they will do in a very, very measured pace. By 2nd June, they will take their time to actually I think open up. Those more essential ones will start to go first. So there's a drag on construction. And we were hoping that, in a normal recession, what happens is that the government, construction is typically basically counter cyclical. Because in a recession, the government will pump in more money and they start to build places. Right now, I think the government will still pump in money. But because the workers, they cannot be out there working as efficiently as they used to. I think that construction will probably the growth of it will be hampered. It will not be like a typical recession. Already in a typical recession, these guys are going to feel the cash crunch. Most people, all the construction guys will be focusing very much on the cash flow. And during bad times, what happens is that they will cut their margins. Some of them will even have negative margins, which means they are losing money. We actually witnessed that even before this current downturn, but this will actually exacerbate the situation. So, I mean, in terms of construction, I'll be very cautious on the sector. Property developers such as Oxley, what's your outlook on property developers such as Oxley, general outlook on market in the next 2 to 3 months? I think that the property sector, obviously, because the general market is not going to be great, people are going to be out of work, property prices will come down. There will still be 14,000 units that's going to be out for sale. It's unlike, say, 2008. I remember in 2008, there were like only 5,000 houses or apartments being put up into the market. This time around, because a lot of the developers have already in their stock or they're already building, so they would have to launch it. And these 2 months of circuit breaker have definitely hit the numbers. You can see we are looking at multi-year lows when it comes to property purchases. But that said, if you look at the bigger guys, CapitaLand, the smaller guys, for one, obviously they are trading at very, very steep discounts to the RNAV. Even for the likes of Oxley, we're talking to a tune of 50, 60, even 70% discount to RNAV. But the bigger guys, the big three, UOL, City Development, CapitaLand, they themselves are also trading at less than 50% discount to or more than 50% discount to RNAV. So if you ask me, I think that they will be safer bets. So when the markets were really to make that rebound, in fact, right now it's high. I think it's going to come off, and they will come off in sympathy. But when it comes to inflection point, these are probably the front runners when the market, like I said, takes off. Do you stick to your view into buying STI at the support level as shared previously? Yes, I do. I think that the market is high. There's really no rush to go in right now. Right now, I didn't check today. Should probably do, but it ended at 2,500 plus the last time around. I thought that a good level to go in was -2 standard deviation, which is 2,360. And I still stick to my guns. When is the stock market going to crash? I don't know. It could be tomorrow. It could be the day after. Like I say, it could be a week. It could be a month. But I think it's sooner rather than later. I'm not talking about 3, 6 months, but because the valuations are high, and I think that very soon the bad economy is going to catch up with the very very strong heavy valuations in the market. Oh, well, that's a loaded question. Your view on ST Engineering, Comfort, they'll go for you, and Valuetronics. Okay, very quickly, I think ST Engineering just issued their numbers 5 to 15% down in terms of earnings. I think that because the aerospace division accounts for 50% of the total revenue, that would definitely have an impact because the planes are not flying at all. So we are looking at, I think the revenue will fall more rather than towards the higher end of the 5%. But when the markets or the skies do open up, I think when a lot of these mothball lanes will have to go for very serious type of maintenance work, ST Engineering will start to bounce back. As it is, I when I last checked was 327, 328. I think that there's still some room to go. The dividend yield, of course, a lot of the dividend yielding stocks right now are trading 5, 6, 7%, right? This one is not too shabby for a big cap. We're talking about 4.5, 4.6 percent. Discounted is something that we can look out for. When things do get sour, I think that there's some resistance already. I think the management have already told you that what's the downside. Comfort Delgro, you can see. I mean, lots of taxis out there all being given up. You can see a sea of yellows and blues, not only out in the street, but in their facility because people are just giving up the caps. Job support scheme will actually help Comfort Delgro. It's been thrashed down. Currently, it probably, I haven't looked at the valuation, but I think that, at a certain level, it may be time to take a look at Comfort Delgro, probably not now. For you, I've always liked the counter. I think that it is very, very resilient. The cash holdings is tremendous. We're talking about 60% of the share price backed by cash, pure cash, net cash. Company has done tremendously in like streamlining its operations, particularly in China. I think that that has helped the numbers with the improvement in US dollars. I think that that's going to bump up the numbers. But I am cautious with manufacturers in China right now, given that again the spat between US and this actually involves the question on Valuetronics because Valuetronics have I believe 100% of the facilities over in China. To you significantly less because they do have Sing and particularly Malaysia. But those with China presence, with the manufacturers in China, even though like say Valuetronics, there's a huge cash haul. But when the sentiments turn down, that could be one of the first that get affected. Because with this spat, it could be trade war part 2. I've answered this one on ST Engineering. Can still buy Riverstone according asked by anonymous attendee. I answered that I think in my presentation. I featured Riverstone up 130, 140%. The valuations I think are fairly high. It is not at the max, the peak valuations, given that growth in the earnings is still there. I think that there will be it will be sentiment fueled, but it's backed up by some numbers. Unfortunately, I think that this particular sector is very, very attached to what's happening to the glove makers in Malaysia because they account for, I think, globally 90% of the gloves. So should there be any fall or weakening over in Malaysia because of overvaluation or what? Riverstone will be affected. I think you only look at Singapore stocks. My expertise is in Singapore stocks. I do look at the global market, but I feel that if you ask, my expertise is really to look at very, very specific stocks, whether big caps, blue chips, or the mid caps or the small ones. So all of them I'm interested in, and I believe in developing a niche at it. I still have a view of the US market. I think it's expensive, right? But if you ask me about individual counters, I don't think that I will be any better than some of the professionals or those guys that have been looking at the market more intently than I do. Any reason why Riverstone PE is trading? Okay, it's back to Riverstone again. It is trading at a discount to Top Glove and the Malaysian glove counters. Because Malaysian glove counters, they are very, very okay. For one, Malaysia counters the Malaysia glove makers are very entrenched in the Malaysian market, and Malaysia is very insular. Many of the big funds there, the government funds there, will invest in the Malaysian market, and therefore, not only for the glove makers, but traditionally, the PEs there tend to be higher than what it is in Singapore. So whether is it on a sector basis or whether is it on a market basis, Malaysia or the glove makers do typically trade higher than Riverstone. So it's really, because like I said, it's very, very close. And the Malaysian government, they do have hefty funds, right? When they invest, there's only that few that they are focusing on. Can share about MedTech. I think I think Jeremy has already done a great job talking about it. There's still a ton of questions. Let me just go through this one on Top Glove. I already answered. Do you foresee a new low to be hit for US and the Singapore markets after March low? I do believe that they will flirt with the lows, and if things there could be a few things that could happen that will bring it down south. Like I mentioned, the second wave. If the trade war between US and China, and it's not only trade war, it's a total it's the relationship. Because once like Donald Trump feels that is losing the grip. I feel that there's this capacity and the capability to actually go nuclear. And this relationship is at risk. And I believe that that could be one of the factors or one of the key factors that actually would bring the markets down. I'll take a couple more questions. This one is already done. Is it okay to spend more time for Terence to answer Q&A? Sure, I'm going to spend a few more minutes, like just looking through this Q&A and try to answer as many questions as possible. Why is Warren Buffett selling bank stocks? Is that gloom and doom for local banks too? I am not too sure whether it's connected indirectly. Of course, you can see Warren Buffett, he thinks that some of these stocks are overvalued, particularly Goldman Sachs. I think he got it during 08, 09 period. And looking ahead, he feels that the market is not going to be stable. And there could be specific reasons why Goldman has been sold down so significantly versus say Bank of America, where he just shaved off some. But one thing is clear, he is keeping his ammunition, and he probably will be looking at what's interesting out of the market, not now, but sometime in the future, something that will give him a good deal. With regards to the banks in Singapore, I've already mentioned, I think many times, there are going to be pressure points. Number one, with the interest rates going down, you can bet your bottom dollar that the interest margins, the NIM, which is very important for determining the revenue, will come off. The interest rates will stay lower for longer, which means that the NIM will be compressed or will stay low for longer as a result. And given that, during these very, very challenging times, there will be blow-ups, big and small. The big one, we've already seen one of them, in Leong, right? It's been talked about. I'm sure that there will be many that will follow suit. And this will actually have an impact on their NPLs. And all these things, if you look at the numbers, what has been keeping banks up over these last few years? People have been buying into the banks because, earnings have been quite generous. Dividends have been great. People have been buying it for the yields. And if the earnings come off, there is a reason cut the dividends. Right now, I think DBS is still putting up a brave front. OCBC is, I feel, a little bit more realistic. But if this thing were to drag on, I think the earnings will come off, and therefore there will be a possibility of a dividend cut. And I think that that will actually lead to pressure on the bank stocks. What do you think about SIA? Okay, SIA, I mean, over the last few weeks, I had a negative view, and I was wondering why, after that X strikes, the exercise, the numbers actually popped up. I think people were just looking at the absolute numbers and started to play up, or they're not very sure about what would be the X strikes, XMCD price. And I mean, it's anybody's guess. I've seen reports between 420 and 490. Whatever the case right now is about 360. It's trading at 0.6, 0.7 to 0.8 times book. There will still be, I think, pressure. It was the most highly shorted stock on the SGX last week. But things can turn. I mean, they can be bashed down to a certain extent. The news continue to be bad. But I think that, when it hits 0.6 times or 0.7 times book, you can take a look at it, because this is one of the companies that the government wouldn't allow to go. And there will be, again, one of those things where, we will continue to pump money. We have already a very, Temasek have already given a very generous package. Should there be signs of further weakening, I believe that they'll stand at the back of it to support the likes of SIA. So in the longer term, my view hasn't changed. I am still negative on the company. I think that there's going to be massive write-downs. The last time around I spoke about, there's going to be unprecedented losses. Plus, the hedging, the oil hedge, which will knock it out by about 2 billion. In the past, I've always mentioned 1.3, 1.4 billion, but I think this has ballooned, and they have really officially said there's going to be over 2 billion US dollars. So all these things are negative, but the prices have been thrashed. I think, like I say, a certain level, there's going to be a good reason why you can take a look at it. Because again, we're looking for the inflection point when the planes start to fly. Now, 96% of the capacity is out there mothballed. They are sitting in Singapore, they're sitting in Alice Springs in Australia. Should they be recalled back because things happen? I think that, we will likely see renewed interest in SIA. I was reading this thing about Hong Kong tourist arrivals. Wow, that was amazingly crazy. Hong Kong tourist arrivals in April was down 99.9%. I'm not even exaggerating. We always say 99.9%. And this is just to basically accentuate or prove a point. But we're not even trying to prove anything. Hong Kong's tourist arrivals was 99.9% down. They only had 4,000 tourists coming into Hong Kong versus 4 million a year ago. That is crazy numbers. We may laugh and scoff, but that's what's happening in Singapore too, because we have totally closed our borders. So there's going to be there's a massive decline in the number of tourists. There's going to be a massive decline, and when markets open up, it will be again very, very slow, to be measured, and people will be feeling their way. So it'll be a long drawn affair, but because the stock price have already fallen so rapidly, maybe something to put on radar screen in the next 1, 2, 3 months. Okay, I'll take one more question before a couple more questions. Struggle, good or dangerous buy? They just opened up. They basically do touristy things. I mean, Shanghai, they have the aquarium. In Singapore, they have that lift. They have the Ferris wheel. So I think it's still, I'm not too sure. I don't know how much it has fallen. I saw the last time I was cliffhanger, it fell tremendously. I'm not sure about the prices right now. So probably would have to take a look at it. You can go into my Facebook and ask me that question. Maybe I'll do a bit of research on it. Okay, I'm gonna take the final question on, okay, what's the last question here? Retail REITs. Retail REITs, again, everything comes at a price, just like SQ. The macro factors may be against them. But for retail REITs, I feel that it's also structural. I've been looking at it and I have not been very, very confident of this particular sector for quite a while right now. Given that, even after this very, very unfortunate episode, there's still the content with the rise of e-commerce. In fact, now more people will be engaged in that. So retail REITs probably not top of my agenda when it comes to the REIT space. REIT space, like I said, logistics will be the least affected of the few sectors. I mean, of course, you have the healthcare REITs, which have been very, very stable. Then the logistics. Then after that, on the lower end side will be the commercial guys and the retail, which I feel that, like I said, both of them will see some kind of like structural change. It may not be immediately after the virus, but it will be accelerated. The thoughts that, and in terms of office space, people are now, I mentioned that 2 months ago, that I was worried that office space uh, will be downsized because people are now used to working at home, right? So they don't need such a massive office space. A lot of the big MNCs are thinking about it, and this narrative have been like driving up, and this has like been gaining traction. So I am quite sure that this will be accelerated, and the commercial side as well as the retail REITs, it will come off and it will bump up. But then, like in the longer term, that's something that you have to reconsider. But one interesting aspect is the hospitality REITs. Since we're on REITs, right? While it's going to be very, very hard. But some of these hospitality REITs, they do have management guarantees, and that will buffer a big portion of the fall. To be sure, the hotels are really facing the pressure. I looked at OUE, Mandarin, again, I think it's Mandarin Hotel. It should be Mandarin Hotel, which they are renaming as Hilton. The numbers, the RevPAR was down 40% to $121, right? And that's in the first quarter. Second quarter is going to be much, much worse. So hotels are going to be thrashed. But when they open up, again, it's an inflection play. At a certain point in time, because all these REITs, hospitality REITs are trading at 0.5, 0.6 times price to book. It could be high, not now, but then at a certain point, when the inflection comes out, as we get closer to the opening up of the countries in terms of traveling, then I feel that we can relook at some of these, and I feel that the bounce up will be quite strong. That's something that played in 2010, right after the global financial crisis. The likes of CDL Hospitality trusted exceedingly well, and look for those hospitality REITs with a lot of Singapore presence. Okay, with that, I'd like to thank everybody for taking your time and share or allowing me to share my market view. Ethan.
Hi, Terence. Thank you, Terence, and thank you, our special guest, Jeremy Yee from Clearbridge. I hope everybody had a very good insight and takeaway for this market commentary. So we will end the market commentary here, and do stay tuned for our next one. So I believe, Terence, there are some questions for you on our investing note post as well.
I'll take a look at that too.
Yes. Okay. So we'll keep everybody updated on the next one, and everybody be safe. Thank you, guys.
Thanks, everybody. Hey, thanks, Jeremy.
Thank you.
Thanks.